Well, there's always value, especially these days, right? So there's a lot of what ifs. So what if the consumer goes down? What if there's a trade war that gets out of control? What if there's a bad election? So those create value for us and obviously for Bill. So we're looking for those opportunities, whether it's a quant quake, a pivot to value, a pivot away from value. Those are all opportunities. People have been saying the American consumer is going to go, drop.
They've been saying that for 40 years.
Exactly,
John,
and that has not happened.
Years. So we have these moments where the quant quake, like you talked about maybe last December, where everything took a leap, and then, of course, there's opportunity. But at near record, we're 0.5% from a record high in the S&P 500, John. Is there any value left to be had?
There's a tremendous amount of value left. I mean, our funds trade at a 10 multiple when the market's at 17. So we saw a lot of good flows the last couple of weeks, obviously, as people have recognized the value. I think the move from active to passive favors active managers because obviously there's less active managers looking and there's more opportunities to be had. So I think the consumer thing is really overplayed. You could go, in the green room, I'm watching SoFi, Incredible, right? So everybody's talking about the student loan debt, but yet there's companies out there who are willing to refinance that $3 trillion or 1.2, whatever you want to put the number at, of millennials who have all this student loan debt at very low rates, thanks to Europe and some of the problems that are happening around the world. Well, so that's a huge refinance.
It is.
So instead of a mortgage refinance, you could refinance what? Your student loans. And guess what you're going to do with that money? You're going to go out and spend. So you're going to go out and buy things, go out to dinner, get a nicer apartment, maybe get a car.
Well, we've got, by the way, I don't know if you read our rundown. We got a show in rapid fire. We got a take on just this, on millennials and debt, and it's not student loans.
I saw your tweet.
There you go. See, that's why I should never tweet. Never tweet. All right, Michael, I'm going to go to you, which talk about interest rates, okay? Does the American economy need either saving or propping up, as sort of the Fed hinted yesterday?
It's pretty tough to believe the economy needs to be propped up. The Fed says, look, we think the base case is pretty good, frankly, but we, the Fed, are concerned about, it always talks about cross currents, whether it's international risks, and it cited Brexit. It talks about trade quite a bit, but it has the notion of taking out an insurance rate cut or two. So we look at that and say, well, probably the Fed will cut again. Does the economy really need it today? No, but the Fed is trying to really take out some insurance again against downward trends down the road.
Yeah, and Leon Cooperman said this to Scott and the gang on halftime from Delivering Alpha. He talked about how, the Fed did not need to cut rates. So let's flip it a little bit, Michael. Instead of a do no harm strategy, is there a chance the Fed harms the economy, maybe in the way John was just talking about, which is encouraging people perhaps to borrow more than they should be?
Sure, that's a possibility. And the idea that when money is really cheap, it covers up a lot of sins, that I think has been playing out in the markets for a while. Keeps some companies around a bit longer than perhaps they should be. So by making that borrowing window wide open, the Fed can do that. Now, against that, though, the repo market's been in a bit of disarray, and that seems to have got the Fed a little bit concerned. But still, by and large, yields are low. Companies are able to access the credit markets pretty well. It's possible the Fed causes the economy to maybe overheat a little bit. But, hey, growth is not that amazing. It's pretty good, frankly, at low twos, but not seeming to blow the top off. So I think we're a ways away from the Fed having a real issue.